Welcome to the Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant located in Oakville, Ontario, Canada. I'm on a mission to become the Google map for hardworking Canadians seeking financial freedom. And today's topic is about the top 10 questions that I got from the other popular video that I had done before on purchasing a Tesla. A year ago, I recorded this particular video on how to save $28,000 of tax payable when purchasing a Tesla. We've since got tons and tons of questions. A friend, actually a close friend of ours, who's also a realtor, a self-employed realtor, made a decision to keep his pre-ordered Tesla Model X because his childhood friend told him that he could get $20,000 back from the government. Well, coincidentally, my previous video did mention that you could potentially save as much as $28,000 of taxes. But do you actually get $28,000 from the government? Since there are so much misconception and so much information out there and so many questions unanswered, I decided to select the top 10 most commonly asked questions to go through today. Every week, I send out an email about money saving tips and real estate tax tips, all designed to help you build your long-term wealth and live life on your terms. The email takes 5 minutes to read and over 10,000 Canadians get it. Think you'll like it. Sign up using the link below. So the first question, do you really get a check of $28,000 back? Well, the answer to that question is no. The $28,000 tax saving in my previous video is calculated based on claiming your brand new electrical vehicle or low emission vehicle, zero emission vehicle that's over $55,000 with 90% of the business use. If I were to order a Tesla Model Y today, I would need to pay roughly about $84,000 Canadian plus HST with zero upgrades. This is a total of roughly $95,000 inclusive of HST in Ontario. The maximum you can deduct is about $55,000 plus HST. Assuming, 1, you did not claim any government rebate. You cannot claim government rebates to qualify for the $55,000 accelerated write-off. 2, you own your own business in your personal name. It's not in the corporation's name, in the personal name. And 3, you have income being taxed at the highest marginal tax rate in Ontario. And the highest marginal tax rate in Ontario is 53.5%. And you use the vehicle for business purpose. All these matters. So if you don't have that assumption, you don't fall into any of that, you may still have tax saving, but the tax saving could be different. You can use the $55,000 extra write-off. You can use it to reduce your taxable income, which is the amount that's subject to tax by the business use of your vehicle. In my example in the other video, the taxpayer uses a Tesla 90% of the time for business use. Hence, he can claim $55,000 plus HST, which is the maximum you can claim when you are buying a qualifying vehicle. Multiply that by the business use percentage of 90%, which is equivalent to $62,150 inclusive of HST. Multiply by 90% business use, which equals to $55,935. Depending on the taxpayer's personal marginal tax rate, he could potentially save as much as 53.5% tax on the tax write-off. This taxpayer can potentially save as much as $55,935 that we calculated earlier. Multiply that by the highest marginal tax rate in Ontario, 53.5%, which equals to $29,925 tax saving. Chances are you're not going to get a check back from CRA, but you will be reducing the amount of taxes that you have to pay the first year you acquire a qualified zero emission vehicle. So number 2 question that I got in the previous video is that Tesla is no longer in the Transport Canada's website to receive any government rebate. So does it still qualify for this $28,000 tax deduction that you mentioned? Well, in the video, I did make the reference to Transport Canada's website so that you can easily grasp the idea of what vehicles would qualify. But the reality is that the Income Tax Act is actually completely separate from the Transport Canada's list of qualifying vehicles for government rebates. The official definition per Income Tax Act is that a zero emission vehicle is a motor vehicle that is a plug-in hybrid with a battery capacity of at least 7 kilowatt, or is fully electric, or is fully powered by hydrogen, or is a combination of the two. Even though Tesla no longer qualifies for the rebate on the Transport Canada's website for the government rebate, based on the Income Tax Act definition that I mentioned earlier, it still qualifies for the extra tax deduction, Class 54 tax deduction. If you are in the market to purchase a vehicle, make sure you check the technical specification, not the Transport Canada's website. Make sure you check the technical specification of the vehicle before you purchase. If it is a completely electrical car, it automatically qualifies. But if it is a plug-in hybrid, you would have to check if it is exceeding the 7 kilowatt emission. The third question that I get asked all the time is, can I purchase a used Tesla and still qualify for the same tax savings? Well, according to the CRA regulations 1102 bracket 26, is really technical now, the vehicle cannot be a vehicle that has been used or acquired for use for any purpose before it was acquired by the taxpayer. Classic Income Tax Act, because they can't speak plain English. So to answer your question, you cannot purchase a used zero emission vehicle and qualify for the bigger tax deduction, unfortunately. You can still get the regular tax deduction, which max out at $30,000 instead of $55,000 plus HST. So you just can't write off the bigger amounts in the first year. You can still claim 30% of $30,000 on an annual basis. Okay, number 4, can I save the same amount if I use my car for employment purposes? Because not everyone has a sole proprietor business and not everyone has a portfolio of rental properties. If you are required to use your car for employment purposes and your employer has issued a T2200 Declaration of Condition of Employment form to you, specifying that you are required to use your vehicle for the purpose of employment, you are eligible for the bigger write-off for your zero emission vehicle if you were to purchase it and qualify, provided that it qualifies for all the other criteria. Similar to the business deduction example I was giving before, an employee is still required to keep track of a logbook of how much employment use percentage they have incurred. You're only eligible to deduct the employment use percentage of the vehicle against your salary. If you receive an allowance from your employer and the allowance has not been included in your taxable salary, your T4 salary, you must also offset that allowance against the deduction. So you can't double dip. You can't receive the allowance and not report it as income. Employment expense is an area of focus for CRA audit. We've got so many clients being audited on this area. Make sure you get all your documentation ready to avoid future headaches. Okay, the 5th question that I get all the time is, can I lease a Tesla and still get the same tax saving? What happens if I lease the Tesla? Is the lease payment still $800? Is the maximum monthly lease payment deduction still $800 per month? Well, the tax write-off is only available if you own the vehicle. So if you are interested in getting the $55,000 plus HST first year purchase write-off, you're only eligible to claim it if you own the vehicle. So leasing the vehicle means that you're not owning the vehicle and therefore you would not qualify to claim the $55,000 plus HST extra deduction the first year. But if you lease the vehicle, the maximum you can claim is $800 plus HST per month. And the maximum amount is further restricted or reduced by a formula developed by CRA, essentially calculated based on the manufacturer's suggested retail price. If you were to lease Tesla today, and based on Tesla's website, you would need to pay about $1,034 monthly lease payment, as it's purely based on their website. You do not automatically get $800 plus HST as your tax write-off, unfortunately. Instead, it goes through this calculation, and it's a complicated calculation. It goes through the calculation to restrict the tax deduction based on the purchase price of your vehicle. So even though you are leasing the vehicle, the lease amount is really calculated based on a manufacturer suggested retail price. In the example in front of you, you can see that if someone were to lease a Tesla today and incur 5 months of payment, so we're in May right now, if that person incur 5 months of payment, total is about $7,238 for the year. The maximum he can deduct based on the formula is only $3,334, not the full $7,238, not $800 times the 7 months that he paid. Lease deduction calculation can get quite complicated. Just keep in mind that it is likely that your allowable lease deduction is less than $800 plus HST, because the calculation really grind down where the maximum lease deduction based on the amount of the purchase price. The higher the purchase price of your vehicle, the higher spread it is above the $30,000, the bigger the grind down is, the bigger the reduction of your deduction would be. Okay, the sixth question that I get asked all the time is, can I finance the purchase of the car and still get the same tax saving? Can I write off the finance payment and interest expense in the future years as well? Well, the answer to that question is quite simple. You still get the same tax saving whether you finance the vehicle or purchase your Tesla outright with cash. You get the same amount of tax write-off, the $55,000 plus HST, assuming you don't collect any government rebate. If you choose to finance the purchase of your car, you also get to write off the future interest expense incurred on the loan, but you do not get the write-off of the loan though. So the loan repayment itself is not tax deductible, again, because in the first year you already write off the $55,000, which is supposed to be the purchase value. How you pay for it is not tax deductible. The interest cost on the loan would be tax deductible. Again, the interest expense would only be deductible up to the business use percentage of your vehicle. Okay, seventh question I get is, what happens if I sell the car? You save so much money in the year that you purchase, but what happens if you decide to sell the car? It gets interesting. If you sell the car altogether and repurchase a regular vehicle, so not a zero emission vehicle, you may have to take a portion of the sale price of your vehicle as recapture. And this recapture income is then being added to your personal income tax, because in my example it's personal income tax, but if it is in the corporation, then it would be in the corporation tax. This recapture income is then taken back as income based on the business use percentage of the vehicle for the year. So let's use an example to explain. If you purchase a Tesla Model Y for $84,000, in my previous example, we talked about Tesla Model Y, $84,000 plus HST, you purchase a Tesla Model Y, and you claim full $55,000 plus HST and worth of capital cost allowance, worth of tax deduction. So you claim $55,000 full deduction in the first year, just like what the law allows you to do. When you resell the Tesla Model Y a few years later for $30,000, from $84,000 you purchase it, now it's being sold for $30,000 plus HST a few years down the road. The recapture income is calculated based on the following. You take the proceeds, which is $30,000 plus HST, multiply by $55,000, which is the maximum you can deduct, divide by the purchase price of your vehicle. In our example, it is the $84,000 plus HST. So the whole formula works out to be $30,000 plus HST, multiplied by $55,000, divided by $84,000 plus HST, and it resulted in $19,643 of recapture income that you might have to take into income. The recapture is $19,643. The actual amount that you would take into income depends on the business use percentage of your vehicle. If you use 10% of your Tesla for business purpose in the year of disposition, then you will take that $19,643, the recapture calculated, multiplied by 10%, which is $1,964 as income. So it really is driven by the amount of business use percentage you have for the year of disposition. What if you sell the car and repurchase another zero emission vehicle? Well, if you sell the Tesla and repurchase another Tesla, the recapture amount is then used to reduce the amount you're eligible to claim. So in our example, the recapture is $19,643. If you repurchase another zero emission vehicle, instead of being able to claim another $55,000 plus HST, you can now write off the $55,000 plus HST minus $19,643 minus the recapture amount. So the maximum you can claim the year when you sell your old vehicle and then repurchase another EV, the maximum you can write off is $42,507. Again, you would need to apply the business use percentage to get the actual tax deduction. The eighth question that I get asked all the time is, can I write off the vehicle against my rental properties and get the same tax savings? Absolutely. The answer is always absolutely. You're eligible to claim automobile expenses against your rental properties, but there are some qualification criteria to claim it. The key here, though, is the logbook. You will have to track the mileage you've driven to manage your properties. Depending on the number of properties you own, if you own one rental property, you can only deduct the mileage if you meet all of the following criteria. CRA has it on their website. One of the criteria is that you receive income from only one rental property that is in the general area where you live. You do part or all of the repairs and maintenance on the property. You have vehicle expenses to transport tools and materials to the rental property. And you cannot deduct motor vehicle expenses you incur to collect rent. CRA said that those are personal expenses if you only own one rental property. I don't know where their logic is coming in from. That's how it works if you own only one rental property. Now, if you own two or more rental properties, the rules are less strict. You can deduct the mileage you incur to collect rent, supervise repairs, and you don't have to be the one doing the repairs anymore. You can deduct the mileage you incur to supervise repairs. You can deduct the mileage you incur to manage the properties as well. And the properties do not have to be in the general area where you live. CRA's rules are really weird, but that's how it works. The benefit is that you own more than one rental properties. One word of caution though, your rental properties have to be located in at least two different sites away from your principal residence. What I mean is that if you have two rental properties, one of which is the basement of your own primary residence, CRA does not allow you to deduct the mileage related to managing your basement tenants. Okay, the ninth question, can the tax saving apply to self-employed business, that is the sole proprietorship or partnership, not a corporation, not a business? Do I need to be incorporated to take advantage of $28,000 tax saving? I hope I kind of answered that question earlier in the example that I gave in my very first video. The tax savings were calculated based on personal tax rate and owning a business as a self-employed individual or sole proprietorship. You do not need to be incorporated to take advantage of the $28,000 tax saving. In fact, you save more. In fact, you save the $28,000 if you own the business in your personal name. If you own your business in the corporation and you are interested in getting a Tesla, the calculation is completely different and it can get quite complex and confusing. Which leads us to the last question of the day. What happens if I purchase Tesla in the corporation that I own my small business in? Well, as I said earlier, this can get quite confusing. Remember, corporation is considered a separate legal entity for you, even though you may be the only sole shareholder of the corporation. Even though it's 100% owned by you, but the corporation is still considered a separate legal entity. If the car is purchased in the corporation and it is made available for you to use as an employee or as a shareholder, CRA wants to tax you on receiving this benefit by having the car available for your personal use. Yep, they're making you pay personal tax on the benefit you deem to have received from having the vehicle available for your personal use. There are two types of benefit that you have to include in your personal tax return as employment income. First one is standby charge, and second one is operating cost benefit. Now, standby charge is calculated based on the original purchase price of your vehicle or the monthly lease cost Number two, it's based on number of months of the car is available to you for personal use. Number three, it's based on the number of kilometers driven for both personal and business purposes. And number four, it is based on the reimbursement, amount of reimbursement you've made as an employee back to the corporation, reimbursing the corporation for the availability of the vehicle for you to use. When your Tesla is owned by the corporation, the standby charge can be calculated as follows. You take 2%, multiply by your vehicle purchase price, multiply by the number of months available for personal use in the year. So in our example, the Tesla Model Y, you take 2%, multiply by $84,000 plus HST purchase price, multiply by 12 months, equals about $22,781. This $22,781 standby charge is then added to your personal income on an annual basis, and you get taxed accordingly based on your marginal tax rate. Kind of sucks because $23,000 added to your personal name out of nowhere just because the car is available for you to use. However, there is a reduction to that amount if you use your vehicle more than 50% of the time for business use. You can have this, you would be eligible for a standby charge reduction. So it won't be $23,000 that we calculated added to your income, it will be less than that. And the amount that's less is driven by the actual kilometer driven for personal use. Say you only drive 1,000 kilometers for personal use and you drive 19,000 kilometers for business use. In other words, you've driven 20,000 kilometers. You've put 20,000 kilometers on this particular vehicle. 1,000 kilometers for personal use, 19,000 for business use. Your standby charge in this example would be taking the standby charge, the 2% amount that we calculated earlier, $22,781, multiplied by 1,000 kilometers, divided by 20,004 kilometers, which is a kilometer set out by CLA. And so your standby charge would then be calculated as $1,139 in our example because of the amount of personal use kilometer being so significantly less than the prescribed amount by CLA. Now, the second benefit that would be added to your personal income tax is called operating expense benefit. Operating expense benefit calculation is a little bit more straightforward. It is based on your personal use mileage, in our example, that is the 1,000 kilometer, and multiply by the prescribed amount specified by CLA. And in 2022, it is 29 cents per personal use kilometer driven by you. So in our example, if you drive 1,000 kilometers for personal use, so operating expense benefit added to your income would have been 1,000 kilometers multiplied by the 29 cents, which would be $290. But there is also an alternate operating benefit calculation available if you use more than 50% of the vehicle for business use purpose. And this alternate operating expense benefit is not always more beneficial than the other way around. In our example, the personal use percentage in our calculation is about 5%. Business use is 95%. So obviously it is over 50%. It's worthwhile looking into the alternate calculation. And the alternate calculation is half of the standby charge calculated earlier. And we calculated that the standby charge from the example above is about $1,139. And you take 50% of it, so the alternate calculation operating expense benefit would be $570. In this particular example, this alternate calculation is actually higher than the regular method that we use to calculate. So we'll take the regular method, the 29 cents times 1,000 kilometers. So the $290 is more beneficial. In summary, this taxpayer would need to include a standby charge of $1,139 and operating expense benefit of $290 in his personal tax return as income. It's not too bad, isn't it? Given that the corporation is paying for almost everything and deduct maximum amount. But what does this really mean in general? Well, what it really means in general is that unless you are using the vehicle almost exclusively, almost always for business purpose. It does not give you any benefit to own your vehicle or lease your vehicle directly in the corporation. It actually could trigger significant tax implication on your personal tax return. The amount you would have to pay in your personal side may not justify the extra tax saving you would get from taking the deduction in the corporation. So make sure you speak to someone who understands standby charge and automobile expense deduction before you put your vehicle in your corporation. Now that we've gone through the top 10 questions that I got from buying a Tesla and saving $28,000, if you have any more questions, make sure that you put it in the comment section below. I've pre-ordered my Tesla Model Y, which is the reason why I kept referring to Tesla Model Y. If you already own a Tesla, any electric vehicle, or if you are considering buying, make sure you let us know in the comment section below. If you have any tips operating the vehicle, let me know as well, because I'm all new to electric vehicle. Make sure you hit the like and subscribe button as well, and share with anyone who's in the market to purchase a vehicle. Until next time.